Welcome. Today we're diving into a fascinating financial mystery that has left even seasoned investors scratching their heads. We're tackling a classic Wall Street puzzle. Why did Microsoft's stock price drop right after the company reported a blowout earnings report on January 28, 2026? It's the kind of event that makes headlines and sparks heated debates among analysts and investors alike. The numbers were undeniably impressive. Microsoft's revenue and profits both soared past what experts had predicted. On paper, it looked like a huge win for the company and its shareholders. But then, something unexpected happened. Instead of the stock price shooting up, it actually dipped, leaving investors and market watchers genuinely puzzled and even a bit frustrated. This scenario is a perfect lesson for anyone interested in stocks or investing. The market doesn't always react to good news in the way you might expect. Sometimes the logic seems upside down. That's because it's not just about the numbers themselves. It's about what those numbers signal for the company's future growth, potential risks, and the expectations already baked into the stock price. To help us unravel this mystery, we're bringing in two perspectives. Alistair, a tech analyst based in London, and Brenda, who represents everyday investors from the Midwest. Together, they'll help us see both sides of the story. Our goal is simple: make sense of why a company can report record profits and still see its stock fall, and what lessons we can learn from it as investors. This isn't just about Microsoft. It's about understanding the often surprising rules of the investing game and how market psychology can drive prices in unexpected directions. When you understand why the market moves the way it does, you become a smarter, more confident investor, ready to navigate the ups and downs with greater insight. So let's dig in together and try to solve the Microsoft earnings puzzle once and for all. Let's look at the numbers Microsoft reported. For Q2 2026, Microsoft's revenue hit $81.3 billion, a 17% jump from last year, and above the $80.23 billion expected. Profits were strong too. Adjusted EPS was $4.14, beating the $3.93 forecast. Net income soared 60% to $38.5 billion. On paper, this is the kind of report that usually excites investors. Revenue and profits both beat expectations, and the company is growing fast. CEO Satya Nadella highlighted the booming AI business, calling it just the beginning. So why did the stock drop? These headline numbers look great, but the market's reaction suggests something else was at play. There's more to the story than just the top-line results. That's what we'll explore with Alistair and Brenda. Before we bring in our guests, let's quickly break down some key financial terms that you'll hear throughout this discussion. Understanding these concepts will help you follow along and make sense of the numbers we'll be talking about. First up is revenue. This is the total money a company brings in from sales before any expenses are taken out. Think of it as the starting point for a business's financial story, representing all the cash flowing in from products or services sold. Next is net income, what's left after all costs, taxes, and expenses are subtracted. This is the company's actual profit, the money it truly gets to keep. Net income is a key indicator of how efficiently a business is being run. Earnings per share, or EPS, takes that net income and divides it by the number of shares a company has. This shows how much profit each share of stock represents, making it easier to compare companies of different sizes. Then there's capital expenditures, or CapEx. This is the money a company spends on big, long-term investments, like new data centers, equipment, or technology. These are assets that will help the company grow and compete in the future. High CapEx means the company is investing heavily for future growth, but it also means there's less cash available in the short term for other needs, like paying dividends or handling unexpected expenses. These four terms, revenue, net income, EPS, and CapEx, are the building blocks for analyzing a company's financial health and understanding its strategy. Revenue shows whether a company is growing, net income and EPS reveal how profitable it is, and CapEx signals how much it's investing in its own future. Understanding these terms helps you look past the headlines and dig deeper into what's really happening with a business. Now let's take a closer look at what these numbers actually meant for Microsoft in their latest financial report. It's time to bring in our guests and hear their expert insights.
Thanks for having me. As an analyst, I can tell you the market's focus is on Microsoft's cloud division, Azure. Azure is the engine of Microsoft's future growth, and investors expect it to deliver spectacular results every quarter. This quarter, Azure revenue grew 39%, an impressive number, but Wall Street expected 38.8%, so it barely beat expectations. More importantly, that 39% was a slight slowdown from last quarter. In tech, even a tiny deceleration in growth can spook investors. Microsoft's stock is priced for perfection, so any hint of slowing momentum in Azure triggers concern. Investors start to wonder, is this the end of hypergrowth? Even a sliver of doubt can cause a sell-off in high-flying tech stocks. And that's why the market reacted the way it did. It's all about expectations.
Alistair, from my perspective, this all sounds a bit extreme. Microsoft made over $81 billion in 3 months and beat profit expectations. How is that not a win? For regular investors like me, this is exactly the kind of company we want to own. Stable, profitable, and growing. When the stock drops after such a strong report, it feels like the market is punishing success. It's frustrating and makes investing seem like a rigged game. We're told to invest in great companies for the long term. Microsoft fits that bill. The idea that a 39% growth rate isn't enough just doesn't make sense to most people. It's like being disappointed with a 98 on a test. Sometimes it feels like analysts are just looking for problems. For us, this was a great report, and the market's reaction is baffling.
Brenda, your frustration is valid. It's tough to watch a company you believe in face a slowdown, especially when you've seen it deliver quarter after quarter of impressive results. But let's take a step back and look at what's really happening here. The key difference is between absolute performance and performance relative to sky-high expectations. Investors and analysts often set the bar incredibly high for companies like Microsoft, especially when a division like Azure has been growing at a blistering pace. Microsoft is a phenomenal company, but its stock price already assumed Azure would keep growing at breakneck speed. The market had priced in not just strong growth, but almost flawless execution and endless momentum. Think of it like a racehorse expected to win by 10 lengths. If it wins by 1, people are disappointed, even though it's still won. The expectations were so high that even a great performance can feel underwhelming. That's what happened here. Microsoft won, but not by as much as everyone hoped. The company still posted impressive numbers, but the gap between reality and expectation led to disappointment. In tech, valuations are based on future growth, not just current results. Investors are always looking ahead, trying to predict what's next, and they adjust their outlooks quickly. A slight slowdown in Azure's growth forces analysts to lower their future projections. Even a small change in the growth trajectory can ripple through financial models and impact long-term forecasts. Over time, even a small change in growth rate can impact what investors think the company is worth. The market is always forward-looking, and it reacts quickly to any sign that the future might look a little different. So while 39% growth is amazing, the market saw it as a sign that the hypergrowth phase might be ending. It's not that Microsoft is struggling, it's just entering a new chapter of more sustainable but slower expansion. The stock price adjusted to reflect a new, slightly less aggressive growth story. It's not punishment, it's recalibration. For long-term investors, this can be a healthy sign that the company is maturing and setting the stage for its next phase of innovation and leadership.
I get the racehorse analogy, but what about all the money Microsoft is spending? CapEx was higher than expected, $37.5 billion versus $34.3 billion. As a business owner, I see investing in new equipment as a good thing. Why is Wall Street worried when Microsoft invests in its future? Building data centers and AI infrastructure seems smart, not risky. If they didn't spend, analysts would complain they're falling behind. But when they do spend, it's seen as a negative. For regular investors, reinvesting profits should be a positive sign. Why does heavy investment make the market nervous?
Great question, Brenda. Spending for future growth is smart long-term, but in the short term, it reduces free cash flow. CapEx is cash out the door now, which means less available for dividends or buybacks this quarter. When CapEx is higher than expected, it makes the company look less profitable in the immediate term. Combine that with slightly slower Azure growth, and investors worry about shrinking margins. The narrative becomes, is Microsoft spending more just to achieve less growth? That's what makes people nervous. For long-term investors, heavy investment is a good sign, but the market reacts instantly to any deviation from expectations. The script was massive, highly profitable growth. The reality, still massive, but a bit slower and more expensive. That's enough to cause a dip.
So, what's the takeaway for regular investors? A stock's price reflects not just current results, but how those results compare to expectations. Microsoft is still a healthy, profitable company, but its stock was priced for perfection. When growth slowed and spending rose, the price adjusted. For long-term investors, this volatility is just noise. If you believe in Microsoft's strategy, a dip like this could be a buying opportunity. Diversification is key. Don't put all your money in one stock, no matter how great it seems. The market can be irrational in the short term. For traders, these reports matter a lot. For long-term investors, it's about the big picture. Know your strategy, stay informed, and don't let short-term swings shake your confidence. Thanks to Alistair and Brenda for helping us decode the Microsoft earnings puzzle.